Out of the 450,000 borrowers that are underwater on their mortgage, essentially meaning they owe more on the property than the value of the property itself, at the end of Q3 of this year, over 60% of those loans were originated this year, which is crazy because that tells us that this economy is slowing down, that we are heading into a housing market crisis, that we're going to experience more and more pre-foreclosures as the moratorium has been lifted and as more and more banks repossess homes. We are heading into a housing market where people are going to start defaulting on their loans because they got a loan that was a little bit too big for them, and because of the down payment requirements and because of the low interest rate and because of real estate agents forcing people to overbid on homes, we have this issue creeping on us. And this is exactly what the government is kind of wanting and the Fed is wanting to bring down inflation and everything, but it's unfortunate for common citizens like you and me that are experiencing those changes. In today's video, we're going to talk about the housing market at the moment and how some of these purchasers in these loans are now being underwater or having less than 10% equity in their properties. We're also going to talk about how prices are not going as down as we think they are and how we're really in a stagflation type of economy. And so if you would like to see more videos on the housing market, personal finance, and the economy as a whole, be sure to like, comment down below your thoughts on this topic, and subscribe to this channel. So those are the facts at the moment, that more and more properties are going underwater and people are actually losing equity in their homes. Earlier this year, a lot of people were buying properties that were listed at a certain price, and because of fear or because of pressure from family or from trying to impress others or even pressure from their real estate agents, they actually went over asking price for their properties. Well, now that the economy has made a shift and we're starting to slow down in the real estate market, a lot of these property owners, these home buyers that bought properties earlier this year, are feeling the effects of this shift in the economy as we move into a recession. And before we start diving more into how these people are losing equity and value in their properties, I want to first talk about something that's a little bit counterintuitive, that's a little bit opposite of what I'm saying, which is that prices of homes are not as low as they actually need to be. Yes, we saw some price drops happening in the summer from June to July, August, and September. But according to this recent data by Black Knight, and Black Knight is a data stats analytics company that talks about mortgages, lending, and real estate as a whole, they recently had their mortgage report and they stated that home prices continued to pull back in October. The month's 0.43% decline, a seasonal adjusted 0.13 decrease, was the smallest seen since prices peaked in June. So essentially what this stat is saying, that even though we had a decrease in home prices, it's not much of a decrease in the grand scheme of things, right? This is essentially just your average seasonal adjusted rate that usually happen during the winter month, right? Usually during the winter seasons, people are wanting to stay put during Thanksgiving and Christmas. And so that's what you're kind of seeing in the market. So we don't even know if it's really the Fed pushing it, the Fed hiking interest rates, that's really kind of bringing the prices down a little bit, or is it just that, hey, we're living during the winter months and prices are going down a little bit? And this is really alarming because a lot of home buyers or people looking for homes at the moment, they're screwed at the moment because yes, during the summer prices were a little bit higher, but at least interest rates are half of what it is right now. And so homes were actually more affordable back then, where people were paying over asking because of the lower interest rates than what they are right now with higher interest rates. Even though home prices went down just 0.43% in the month of October, homes are still not as affordable. They're actually more expensive. And so yes, you saw that during the summer, people noticed, okay, this is absolutely ridiculous what's happening to the housing market. And they started to drop at a decent rate from June to July to August to September. But now that people are adjusted to the new interest rates and maybe home builders making adjustments and flippers making adjustments, apartments and home sellers is doing things different, the rate at which the slowdown is happening is actually not at a good rate that we need to be in order to get out of an inflation and make it more affordable for people to buy. And one reason for that is because of new listings. There are not as many new listings happening during this time as they did pre-pandemic. According to the same report, they stated that new for sale listings in October were 19% below 2017 to 2019 levels, marking the largest deficit in 6 years. Outside, of course, the pandemic during the March and April months when much of the country was in lockdown. And so you have this dilemma from a lot of homeowners, home buyers, that yes, there is an affordability issue. I can't even afford the same price home that I could have afforded earlier this year, even if it was a higher price earlier this year. And then on top of that, there's still a short supply of homes, 19% less of pre-pandemic levels. And so homeowners, they have to stick to where they're at. They have to either live in a property that's not in the best condition or an area where they're ready to move out of, or continue renting from a place. And I think another reason why is because a lot of home sellers still don't have in their mind that, hey, the economy is shifting. And so they still have high prices on their mind. And so they're okay with letting their property sit for a month, 2 months long in order to get a higher price. And then a lot of them are actually taking their listings off of the market because they know that this shift is going to happen. And so as more and more sellers opt not to list their properties, that decreases the supply for people actually looking for homes to buy. Now let's talk about these low equity properties that were recently purchased this year and some of the properties that are actually underwater, because yes, the price and value of the homes are not going as low as we want to, but we still have an issue with people not purchasing a property at the appraisal value because they know interest rates are higher and they know that the recession is here and is upon us. And so people are not going to pay those prices for those appraised value homes. And so yes, we do have an equity issue, even though prices are not going as low as we want them to. Now, negative equity properties, which is essentially when you owe more than the actual value of the home, are at historic low levels because we had this extreme boom that happened. But a lot of these negative equity properties are properties that were mostly bought this year. So let's say you bought a property when the pandemic hit and you were actually able to get a discount, or late 2020 or even most of 2021. You have a good enough cushion, equity cushion, in order to have a positive equity on your property. And so most of these negative equity properties are coming from this year, purchased this year. And going back to this report, 60% had been originated in the first 9 months of 2022. All in, 8% of purchase mortgage originated thus far in 2022 are now marginally underwater, with another 20% in low equity position. Among FHA purchase mortgage holders specifically, more than 25% has slipped underwater, and more than 3/4 have less than 10% equity. So this is crazy that a lot of these negative equity properties are happening this year. And so to give you all a story of myself, I purchased the property this year, and I actually purchased an investment property. And so I couldn't qualify for a low down payment loan like a FHA loan or just a low down payment conventional loan. I went more on the investing route. And so I had to put a larger down payment. And so that actually helped me retain equity and protected me from this downturn that we're about to have in the economy. And then on top of that, I made sure I looked at my budget and bought a property that fit my specific budget. My property was listed online for sale by owner, and I was actually able to get close to 10% lower than asking price. You could have still gotten good deals, but I think people were just in a rush before interest rates got higher and before this and that. And now, yes, their property is technically more affordable than what it is now, but they paid a little bit too much and they borrowed or just over leveraged themselves, and they have a payment that doesn't fit their budget. And it's sad that a lot of these underwater properties are happening with people with FHA or VA loans, because these are the properties that require or doesn't require a large down payment. And so they don't get to have instant equity in their property because they're not putting a good enough down payment. And so yes, most of these underwater properties or properties less than 10% equity makes sense, because yes, of course, I'm not going to own 10% of my property if I only put 3.5% down at closing. Yes, unless my property goes up like 10%, yes, I'll have that 10%. But even in a perfect economy, or in an economy where the value just stayed the same, my equity amount would still be less than 10% because I only put 3.5% down in the beginning of the year. And so you have to make sure you look at the stats to really understand that, because it may not be entirely bad if you own less than 10% or you have less than 10% equity, as long as your payments is good. It's less than a quarter, or between a quarter and third, or a third of your monthly budget that you have allocated towards living expenses. But it is still alarming that you have a big debt, especially if it's a larger house and you took out a lot of money down on this property. To have a low equity amount, especially as we enter into a recession, can be a little bit scary. Now, the other interesting thing about this report that caught my attention is the EPD rate, which is essentially the early payment default rate. And they stated that this rate, which captures mortgages that have become delinquent within 6 months of origination, has risen among FHA loans for much of the past year to reach its highest level since 2009, excluding the months in the immediate wake of the pandemic. Do you all understand that? Essentially, what they're saying is for loans that were purchased and they're already defaulting on their payments within the first 6 months of getting that loan. So let's say I bought a property in January of this year using a FHA loan. I'm already not paying my loan because of whatever reason, most likely because I can't afford it, within the first 6 months of this year. So like, let's say March comes along and I just can't pay it. Like, I'm in that stat. Thank God I'm not in that situation, but some people are, and they're reaching the levels of 2009, which was of course one of the worst housing crashes that we had in American history. So when you see stats that are very similar to what happened in 2007, 2008, 2009, those are reasons for concern. That needs to put in your mind, make you realize that, okay, we are in a serious situation. We are definitely coming or going into a recession, and the housing market will be affected. All right, so what can you do as a prospective home buyer, or if you're in this situation, or even if you're an investor like myself? If you are looking for a home, stick to your budget. I try to tell people, don't buy a house that's more than a quarter, more than 25% of your income. That's what you want to allocate towards your living expenses. Most people say a third, so which would be around 33%. So if you fall between 25 and 30%, I think you're relatively good. And I think you all need to stick to that budget. Another thing is, do not be afraid to lowball sellers, right? I just made an offer on a property that I put in an offer maybe about 15% less than asking price, and I have them paying all of the buyer's fee. Now, that's just my offer. They countered with me back a totally different offer, but don't be afraid to make those type of offers if you need to, so you can stick to your budget. I think another thing for investors, this may be a prime opportunity for us to buy properties, especially as we see prices go down. We're still not at that level with home prices, but maybe by mid 2023 or late 2023, we'll have some discounted properties that we can take advantage of and just invest in, renovate, and put it back on the market, or hold as a rental, or just buy it for ourselves. So if you're an investor in that situation, make sure you do that. Another thing, if you're in these positions, talk with your lender, talk with your bank, see if there's any programs out there to help you out. And if you have low equity, but you can still afford these payments, you may be fine because you have low equity, because you only put 3.5% down, because you put 5% down, which makes sense. But as long as you can afford these payments, you'll be good. But if you're underwater with your property, now that's that's a reason for concern. And you need to consider, okay, do I just want to get rid of this right now and rent something in order to buy a property maybe sometime next year when property values are lower? Maybe consider that before it gets even worse, right? Before you default over a year from now and now the bank is calling you. These are things that you have to consider. All right, you all, make sure you all like this video, subscribe, comment down below, and I'll talk to you all later.